everyone's chasing the next AI rocket. I'm doing something different. This is the portfolio I'm funding with real money, built on structure, strategy, and patience. Why? Because AI isn't a fad. McKinsey estimates it could add $4 trillion a year to the world economy by 2030. I'm not going all in on hype. I'm building in layers, with ballast, defense, and dry powder. Let me show you every layer, every role, every dollar's job. So let's build it. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. Layer 1. 25% S&P 500. Core stability. Every house needs a foundation. For me, that's the S&P 500, through the VOO ETF. Why? Because the AI giants are already inside it. Microsoft, Amazon, Apple. You get exposure to AI without betting the farm, and you get ballast for when tech gets volatile. This layer is about long-term resilience. It balances out the more aggressive plays, so I can stay invested even when volatility hits. A lot of young investors skip this step, but to me, it's what separates a gambler from a strategist. Layer 2. 30% semiconductors. The engine room. Semis are the picks and shovels in the AI gold rush. I'm going for individual names here. TSMC, NVIDIA, ASML, and Broadcom. NVIDIA isn't just hype. It's become the de facto AI compute layer. Their CUDA ecosystem is a moat. TSMC is the godfather of fabrication. No chips without them. ASML? They make the machines that make the chips. Literally. And Broadcom quietly powers networking, custom silicon, and enterprise infrastructure. Under the radar, but essential. These names are hot. NVIDIA's been on a tear, so I'm not dumping in. I'm dollar cost averaging into this layer slowly. I want exposure, not exposure therapy. Over the next 12 months, I'll be buying in tranches. This way, if there's a pullback, great, I get a discount. If not, I still build my position. The key is discipline. Layer 3. 20% cloud and AI platforms. The infrastructure layer. This layer is the operating system of AI. Microsoft Azure, Amazon AWS, Google Cloud. These aren't hype plays. They own the servers AI runs on. Microsoft is integrating AI across their stack. Not just Azure, but Office, Teams, GitHub. Amazon's Bedrock platform gives every business access to models. And Google, well, they've got the tech, but they need execution. Again, I'm DCAing this layer. These aren't cheap right now. This layer is about leverage. These companies don't just use AI. They enable it for everyone else. That's a strategic position, and it will only grow in importance. Layer 4. 10% cybersecurity. Defense as offense AI expands the attack surface. So, I want exposure to defense. CrowdStrike's Falcon platform uses AI to hunt threats in real time. Palo Alto is quietly rolling up the space with smart M&A. Scalar plays the zero trust angle. Perfect for cloud-native AI systems. I might go with CIBR, the ETF, to keep it simple. But these are the names I'm watching. There is no AI without trust. The more we automate, the higher the stakes. This layer is about securing the future we're building. Layer 5. 10% dry powder. Future optionality. This is my strike fund. If Tesla crashes or Palantir finally retraces, I want ammo. I'm not forcing entries. Sometimes the best trade is patience. Dry powder is underrated. It gives you the flexibility to act when others panic. And when the AI hype cools off, that's when I plan to strike. Layer 6. 5% non-AI hedge. When AI stumbles, this might fly. Every theme has a winter. If AI underperforms, I want one slice of this portfolio moving to a different rhythm. That's why I'm adding 5% into something non-correlated. Could be energy. Could be a commodity ETF like DBC. Could be an emerging market like India or Latin America. anything driven by different forces than tech. This layer does two things. 1. It buffers drawdowns when AI gets hit. 2. It gives me firepower. If AI stocks go on sale, I can rotate capital from here and reload my high-conviction bets. This isn't me being bearish. It's me being realistic. Diversification isn't about watering down your ideas. It's about surviving long enough to double down when it counts. Quick note on maintenance. A portfolio is like a classic car. Build it right, then tune it. I'll rebalance once a quarter. Not monthly, not when Twitter panics. Quarterly. If any layer drifts more than 3 percentage points from its target, I trim winners and top up laggards. Why so disciplined? Because the market's favorite trick is swapping euphoria for despair overnight. Rebalancing forces me to sell high and buy low automatically. No bravado, no second guessing. That's how you stay wealthy, not just get wealthy. Every layer has a role. S&P anchors the portfolio. Semis are the backbone of compute. Cloud platforms deliver the AI. Cyber secures it. Dry powder keeps me opportunistic. And the hedge. It's the insurance that might just outperform when everything else stumbles. This isn't YOLO investing. It's structured exposure. And by dollar cost averaging, I protect myself from timing mistakes. Most investors lose not because they pick the wrong stock, but because they panic at the wrong time. This structure helps me stay in the game. This isn't the final form, just the start. I'll update this portfolio quarterly and do full deep dives on each layer. I want to break each theme down in future videos. Semiconductors, cloud, cyber, even individual stocks like Nvidia or Palantir. What makes them tick? What risks I'm watching? And what could shift my view? Tell me what stocks you'd add or subtract. The comments are open. And if you're building your own version of this, I'd love to hear about it. Seriously. I read every comment, and I'm always looking for sharp ideas to refine this strategy over time. This is a living strategy. If you're building for the long term, not chasing the latest trend, you're in the right place. This portfolio's just getting started. Be industrious, brothers. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.